Let's jump in. We're going to talk today. Quick reminder, live today, recorded next week, live again on 2 weeks from today, which would be August 15. So that said, a lot to talk about. Last week, I reported that recession is here. This week, that was confirmed. However, don't call it a recession. And United Nations had an article up for a day stating that world hunger was a good thing, rather baffling. Auto sales are now declining, and inflation is now taking a toll on consumers. I've got some exact numbers for you. The Fed last week increased interest rates another 75 basis points now. The Fed funds rate is now between 2.25% and 2.5%. I'm going to give you my forecast for what is next. So a lot to talk about here today. So let's go ahead and jump in. This is from Zero Hedge, and it talks about the Atlanta GDP Now, which the Atlanta Federal Reserve has a GDP Now metric. And the first estimate of the second quarter gross domestic product is a negative 0.9%. First quarter was a negative 1.6%. This is the second consecutive quarter of declining gross domestic product. Put another way, it is the second consecutive quarter of economic contraction. That is the technical definition of a recession. Now, digging into this data, the underlying causes per this article were decreases in inventory investment. So companies are not investing to expand inventories. You have to think that companies who are not investing to expand inventories are concerned about the economic outlook. Housing investment was down. Believe it or not, federal government spending was down, as well as state and local government spending, as well as business investments. Exports and consumer spending increased. Imports also increased, and those obviously take away from GDP. So trade deficits reduce GDP. So according to the Bureau of Economic Analysis, the decrease in inventory investment was largely in the retail area, also in autos, as we'll talk about here in just a moment. Brokers' commissions and housing were down. Decrease in federal government spending was really a decrease in non-defense spending. Defense spending did go up, and state and locally, governments did not invest in infrastructure. The decrease in business investment reflected decreases in structures and equipment. So businesses are not investing to the extent that they were in infrastructure. The increase in imports reflected an increase in services led by travel. The increase in exports reflected an increase in both goods and services, and the increase in consumer spending, really not surprising that it was led by food services and healthcare. So these are the places where inflation is really kicking in. It's also important to remember that when GDP is measured, it's measured in terms of US dollars. So as US dollars are devalued, it tends to make the reported economic data look more favorable, because the dollars in which the economic data is being reported are not buying what they did even 6 months ago, as we'll talk about here in a second. So personal consumption rose, fixed investment declined. That in essence is the report. So we do have a recession here. Inventories, as I mentioned, are down, exports are up. And we're not supposed to call this a recession. Yellen, who is the Treasury Secretary, the former actual Federal Reserve Chair, stated this week that this doesn't necessarily mean that we're in a recession. And Ryan McMakin of Mises Wire, and I do appreciate the perspective of Mises, had this to say: in September of 2008, the worsening global financial crisis hit a new phase when Lehman Brothers collapsed, and it became undeniable that hard times had arrived for ordinary people. By then, the unemployment rate had been climbing for months. Foreclosures had skyrocketed and the yield curve had been inverted through much of 2006 and 7. The research, National Bureau of Economic Research declared that what we now call the Great Recession had begun in December of 2007. In other words, by the time a recession was declared, the U.S. had already been going down that road for nearly a year. Right up until Black Monday 2008, it was controversial if you said the U.S. economy was in recession. As late as August of 2008, then presidential candidate John McCain repeatedly declared the U.S. economy to be in good shape. The Federal Reserve Chairman Ben Bernanke denied any recession was in progress. Of course, they said those things. They had to, because they had to be politically expedient. The gaslighting, McMakin says, and ignorance of the experts and the policymakers in 2008 provide some helpful context to Janet Yellen's effort this week to control the narrative over what a recession is. And of course, political expedience is once again something that politicians and policymakers are mindful of. The Biden administration is attempting to control who uses the word recession and when. This will become even more politically important as Americans continue to face ongoing threats to their standard of living and the current age of inflation and stagnating wages. Yellen was on Meet the Press. This would be a week ago yesterday. She was playing down any economic news that suggested the U.S. economy was in recession. Yellen said what a recession really means is a broad-based contraction in the economy. And even if that second quarter GDP number is negative, we are not in a recession now. So to heck with the fact that 2 quarters of negative GDP growth has always been the definition of a recession. When I studied economics in college, that was the definition of the recession. Yellen now says that we should not be characterizing that as a recession. A recession really means a broad-based contraction in the economy. Well, if you have economic contraction for 2 quarters, I would classify that as a broad-based contraction in the economy. Now, I couldn't resist this. I live in farm country, and where I live, we have a saying for what the Treasury Secretary is trying to do. She's attempting to put lipstick on a pig, but no matter how much lipstick you put on a pig, it's still a pig. You can call economic contraction anything you want. It's still economic contraction. And this economic contraction, I believe, due to private sector debt levels, of which we have been talking about, will have to intensify. Now, the United Nations, surprisingly, ran an article on their website that was taken down after a couple days. And this is the article. It was titled "The Benefits of World Hunger." George Kent wrote the article, and he is a professor of political science at the University of Hawaii. The article starts by saying, we sometimes talk about hunger in the world as if it were a scourge that all of us want to see abolished, viewing it as comparable with the plague or AIDS. But that naive view prevents us from coming to grips with what causes and sustains hunger. Hunger has a great positive value to many people. Indeed, it is fundamental to the working of the world's economy. Hungry people are the most productive people, especially where there is a need for manual labor. I don't often get political, and this is not intended to be political, but this, in my view, is sheer arrogance. Now, this is from Zero Hedge, and they reported that the article remained on the UN website for a day or so before being deleted after it went viral on social media. And you can understand why it went viral. It's hard to believe that something like that would be posted on the United Nations website. Now, there is a lot more about this, but the article writer at Zero Hedge says the repercussions are now spilling over into the lives of Joe Sixpack, which is a bit of a derogatory term referring to the average guy. He said, Joe really doesn't care to hear about the United Nations sustainability agenda or about their absolute zero report, which details very clearly and precisely what is taking place right now. He said, none of this is an accident. Contrary to what many think was or is incompetence, is neither. The Great Reset requires a populace beholden to the government and nobody else. And while Joe Sixpack doesn't understand most any of this, he really doesn't need to. What Joe does care about is when he can't afford his groceries and when his electricity bill now suddenly wipes out his entire annual disposable income. And that is now actually happening for many households, as we'll talk about. Now, there is the head of Five Star, Giuseppe Conte, said, I have a strong fear that September will be a time when many families will face the terrible choice of paying their electricity bills or buying food. We are absolutely willing to dialogue to make our constructive contribution to the government to Draghi, referring to Mario Draghi, but we're not willing to write a blank check. So they're concerned about this in Italy. And when you take a look at this, this is the cost, a graph actually showing the cost of electricity in German in euros. And take a look at how that has spiked to an all-time high, more than tripling literally this year, just for the cost of electricity. When you take a look at the consumer price index in Europe year over year, you see that CPI is up significantly. And if you look at the CPI here in the US, it's 9.1% officially, but when you look at John Williams' website, it's actually 17.3%. This chart actually is from Williams' website, Shadow Stats, and the blue line on the chart calculates the inflation rate using the methodology that was used prior to 1980. And you see now that gets the inflation rate around 17%. The red line is the official headline consumer price index. Now, many of you have been aware of what's going on in the Netherlands. This article writer talks about the fact that the other thing the average guy or Joe cares about is when the government, under the guise of saving the planet, begins the process of stealing up to 50% of the farms in the Netherlands. Under the ridiculous narrative of reducing nitrogen emissions, the Dutch government is proceeding with a blatant land grab of 30% of the farmland. It's worth pointing out that 78% of air is nitrogen. Over in France, France will fully nationalize its utilities. The Prime Minister said on Wednesday in a move that would give the government more control over restructuring of the debt-laden group while contending with a European energy crisis. So extreme circumstances bring on extreme politics, and certainly if you go to the World Economic Forum's website, there's no secret as to what the agenda is. Now, in other news, auto sales are beginning to turn around. July new vehicle retail sales are expected to crash by almost 11%. According to a new projection by J.D. Power, the new sales of new vehicles are expected to reach 988,000 units in July of 2022, down 10.8% for July of 2021 when adjusted for selling days. Without adjusting for one less selling day in July of 2022, the plunge would have been over 14%. Total new vehicle sales for the month, including non-vehicle sales, are expected to plunge to 1.15 million units. That's down 5.7% from a year ago. Without the selling day adjustment, the fall would have been over 9%. Thomas King, who is president of the Data and Analytics Division at J.D. Power, said this, quote, July is another month where supply constraints keep vehicle sales artificially low, but deliver record transaction prices and dealer profitability. July is on track to be the 9th consecutive month that retail inventory closes below 900,000 units as anticipated improvements in vehicle production volumes failed to materialize. So we have vehicle sales dropping. We have confirmation of a recession. and we have inflation that is continuing to affect consumers. As inflation rises, it consumes more of the discretionary income of more Americans, and that's a huge issue given that over 70% of the U.S. economy is dependent upon consumer spending. Now, Peter Schiff correctly notes, and Schiff has been a past guest on my radio program, that Americans are paying for big government through the inflation tax. Peter was on a radio program and he said that I think that as the inflation gets stronger, the economy gets weaker. He thinks the recession is just getting started and it's going to last a long time. I would tend to agree with Peter. Peter said that when you talk about families struggling with inflation, they're really struggling with government. He correctly notes that inflation is a tax. It's a way the government finances deficit spending. Government spends money it doesn't collect through taxes, so it has to run deficits. The Federal Reserve covers those deficits by printing currency, by creating currency. They call it quantitative easing, but it's inflation. Government is getting bigger and bigger, and families across America are going to have to bear that burden through higher prices. There is nothing free. So there is now a bill that has passed the House, which is a bill to battle inflation. It is essentially most of the Build Back Better program repackaged. It will exacerbate inflation because it increases government spending. The government has also artificially suppressed interest rates for years. We know that. Peter said, now we're going to have to pay a heavy price to unwind all these policy mistakes. That's why this recession is going to be so severe. That's why this financial crisis is going to be worse than the one we had in 2008. I've interviewed many guests on the radio program that would disagree with that assessment. However, I would tend to believe that Schiff here is going to be correct. Schiff correctly notes, as I note in the August You May Not Know report, that in order to get inflation under control, you have to have real positive interest rates. And according to John Williams, with an inflation rate of 17.5% and a 10-year U.S. Treasury yielding less than 3%, we still have real negative interest rates. We have to get real positive interest rates to get inflation under control. So the Fed has not done nearly enough. Schiff said the inflation situation is far worse than the CPI indicates, which has been heavily manipulated. Schiff says we're heading for an inflationary depression. He says he doesn't know what it will take for the government to do the right thing. He said the only way you can fix this is to cut government spending and allow interest rates to rise to a more normal level. And I believe that that is definitely the case, but that creates a deflationary environment, which we are going to have to endure at some point to get things back to a more normal type environment. Now, the Fed has increased interest rates. I happen to believe that the Fed is likely going to reverse course. I happen to believe sometime in the next 12 months, probably sooner, the Fed will begin to cut rates, citing that the economy needs support. That will continue to feed inflation. Now, Ryan McMakin, again from Mises, had this to say about the Fed's rate increase. He said, recent indicators of spending and production have softened. Nonetheless, job gains have been robust in recent months and the unemployment rate has remained low. Inflation remains elevated, reflecting supply and demand imbalances, higher food prices, higher energy prices, and broader price pressures. So the Fed raised interest rates 75 basis points, 0.75%. That's what most people thought, most prognosticators thought would happen. But McMakin says that now leaves us with a very important question. What's now? What's next? And he said the Fed doesn't know. The weakness of the present economy will keep the Fed very cautious moving ahead. As is clear from Powell's press conference on Wednesday, Following the release of the Federal Open Market Committee statement, the Fed is still holding out hope for a soft landing. I believe it is too late for that. The Fed is hoping to reduce inflation without weakening the economy too much. As I've said, I think that's going to be nearly impossible to do. So the Fed, after 6 weeks, the Fed went from saying economic activity appears to have picked up. That was at the June meeting. And now, 6 weeks later at the July meeting, the Fed said recent indicators of spending and production have softened. I have to tell you that not that much changed in those 6 weeks other than what the Fed had to say about it. The fact that the Fed has no idea how things will go is emphasized by Powell's admission that the Fed isn't planning to offer any more forward guidance this year. They're not going to tell us what they're going to do. McMakin says that frees the Fed up to make more last-minute decisions and to more aggressively make things up as it goes. Specifically, Powell said that moving forward, we think it's time to just go to a meeting-by-meeting basis and not provide the kind of clear guidance that we did on the way to neutral. So Powell is saying, we just think we're going to go meeting to meeting. McMakin says the translation is things might go even more off the rails at any time, so let's just play it by ear. Powell said, like Yellen, the economy is not in recession, even though there have been 2 quarters of economic contraction, which is the textbook definition of a recession. He did say, though, growth is going to be slowing down this year, and a path to reducing inflation without a recession has narrowed and may narrow further. What he's saying is, get ready, it's here. McMakin correctly notes these are not the words of a man with much confidence he can do what the Fed has long promised. The Fed line for years is that we're not going to let inflation get above 2%, and we have all the tools we need to make sure that happens. McMakin says all that big talk, you don't hear it anymore. So I think we are headed for a recession, and McMakin, as I noted here on this Headline Roundup webinar, said a 2.5% target rate doesn't even exceed the Fed's timid rate hikes of 2019. And yet, look what's going on in the economy. When the Fed hiked rates in 2019, the Fed only had $4 trillion on its balance sheet. Total assets have doubled since then. Actually, they've more than doubled. The Fed's balance sheet is now $9 trillion. And the Fed hasn't done anything to reverse this. So a 2.5% target rate means a lot less now because the Fed has created a lot more currency. Politically, today's rate hike may be enough to allow the Fed to claim it is doing something about inflation. However, it's really not going to do much about inflation because we're so far from real positive interest rates. The Fed chickened out in 2019 and reversed course. I believe they're going to do the same thing again now. That's what I wanted to cover today. If there are questions, we'll go ahead and take a moment and see if you have any questions. Mark, do we have anything that we need to talk about?
There is one. Jeff has a comment that he'd like your feedback on. He says he's heard an interesting analysis from an interview by Adam Taggart on his Wealthian channel recently that the Fed printing money does not actually result in inflation because the Fed only prints this money to buy treasury bonds from the banks who hold them as reserves. Then these banks in turn deposit those funds back at the Fed so it stays out of the general economy. The only way we get real inflation is from the government giving money to citizens, which has now stopped. Current inflation is supply chain related, which will pass. He would be interested in your opinion on that.
Well, I don't know when the government quit giving money to citizens, but I would take issue with that because the government is giving money to citizens on a lot of different levels. And the government is operating at a significant deficit to do so. that deficit is being monetized by the Fed. So the government is issuing treasury bonds to finance its deficit spending. So I think the whole premise of, and I know Taggart well, I respect him. I've interviewed Dr. Chris Martenson, who is a partner of Adam Taggart and a co-author. I just think he's got it wrong. In order for the government to give money to citizens, and it happens every month through a number of programs, again, we don't need to go through them. Many people get checks from the government every month, and the government's operating at a deficit. To fund that deficit, they issue debt, they issue treasuries. The Federal Reserve is creating currency to buy those treasuries. So that money does not stay in the banking system. It goes out into the general public because the government is writing checks to a lot of citizens every month. So I think the whole premise of that argument is just not correct. So I would take issue with that. And when the government actually does quit sending checks to consumers and citizens, I mean, we haven't seen stimulus, but that doesn't mean that there's not checks going to citizens. There are, and it's a lot of money, and the government's operating at a deficit. So that's where the inflation comes from. So I would just take issue with it for those reasons.
Okay, I think we've got time for maybe one more question here. There's two on the board. They're fairly similar. So one is, why has gold fluctuated so much? And the other is, what's the difference between buying an ounce of silver versus buying old silver coins?
Well, when it comes to buying silver and you're buying old coins, if you're buying pre-65 coins, just 90% silver, I would say there's not a lot of difference other than the form in which you buy it. Now, that would not be true if you're buying coins with collector value. I am far from an expert on buying coins with collector value, so I try not to go into areas that I'm not more familiar with, and that's an area that I don't go into. I've talked about the gold and silver pricing. I think given the trial that has been going on in Chicago regarding price manipulation and spoofing in the metals markets, I think that market is largely manipulated. I also think that it's when you look at gold and silver prices tend to track the monetary supply, and it tends to lag a little bit, as my interview with Michael Oliver indicated. So I think two issues. I think gold and silver I'm very bullish moving ahead for reasons that I've outlined, and I think we've seen some price manipulation. So that would be my answer to both of those questions.
Okay, well, time tells us we need to wrap it up. Jeff did clarify that it was not Adam that made the comment. It was the guest he was interviewing. So unless if there's something else you want to add, Dennis, otherwise I know you've got a time constraint and I want to make sure we get you out of here on time.
I'm interviewing Alistair McLeod in the UK in 2 minutes. So appreciate that, everybody. Alistair will be on the program this week. So looking forward to his take on these topics. So again, recorded next week, live in 2. Have a great week.